Welcome. In this video, we are going to analyze how many Xcn'S do you need for $100,000. Don't forget to subscribe and like, and please watch to the end to understand.
But first, let's analyze the Xcn.
Descending trend lines are among the key structural elements closely monitored by investors when performing technical analysis in the markets. Especially during price movements that clearly show a downward trajectory, a descending trend line that is drawn and tested multiple times without being broken often indicates a strong resistance level. In such cases, investors watch closely as the price approaches this trend line and may adjust their positions in anticipation of a potential breakout, expecting the price to reverse upward. When the price touches the descending trend line multiple times but fails to break through, it confirms the significance and validity of the line as a technical resistance level. Each touch shows that sellers are stepping in to push the price back down. This reflects market psychology. Every rejection at resistance reinforces the belief among most investors that buying pressure is still insufficient and the trend remains downward, prompting continued selling activity. However, this pattern doesn't persist indefinitely. Over time, buying pressure can build, and the market sentiment may begin to shift. Breaking a trend line is not solely about the price surpassing a level. For a breakout to be considered healthy and reliable, it must be confirmed by a close above the broken level and, ideally, supported by increased volume. When a descending trend line is broken to the upside, the level that previously acted as resistance can now become a support. This transformation begins with investors psychologically accepting that the resistance has been surpassed, and many then enter the market to join the new upward trend, pushing the price even higher. Post-breakout price movements are often sharp and swift. Investors who were previously hesitant to enter due to the descending trend line may now join the market following the breakout. This creates a breakout effect. If the price had approached and been rejected by the trend line several times before, the breakout becomes even more significant. Repeated tests fuel the expectation that a strong upward momentum may follow the breakout. In technical analysis, investors sometimes interpret these descending trendline breakouts within the context of chart patterns. For example, descending triangle formations or wedge patterns that develop alongside descending trends can indicate specific target levels based on technical pattern measurements when broken. Therefore, it is important not only to identify whether a breakout has occurred, but also to consider which technical targets may come into play afterward. Repeated touches to a descending trend line without a breakout can also indicate accumulation by patient buyers. In these areas, volume may decline and volatility may drop. However, at the moment of breakout, this pressure can be released, accompanied by a surge in volume resulting in sudden price movements. This represents a technical behavior known as a volatility squeeze breakout. A descending trendline breakout may signal not only a short-term shift, but also a potential change in medium to long-term direction. If the descending trend has been in place for a long time and the breakout is supported by high volume, it may indicate the beginning of a new bull trend. In such cases, investors should pay attention not only to technical levels, but also to market news, project developments, and general market sentiment. Sometimes after a descending trend line is broken, the price may return to test this line again. In technical analysis, this is called a pullback. A pullback is a test of the broken trend line now acting as support. If this test is successful, meaning the price does not fall back below the level and starts to rise again, it is interpreted by investors as a buy signal. During a pullback, low volume followed by increased volume on the rebound strengthens the validity of the breakout. From a psychological perspective, a descending trendline breakout increases optimism among investors. During prolonged downtrends, pessimism builds up in the market. A breakout begins to dissipate this negative sentiment. Investors often see the breakout as a sign of hope, laying the groundwork for new buying waves. However, for the rally following a descending trendline breakout to be sustainable, the price must begin forming higher highs and lower lows, establishing an upward trend structure. This pattern provides investors with positive signals about both price direction and market confidence. In conclusion, a descending trend line that has been tested many times without being broken is considered a strong technical barrier. But once this barrier is broken, it can lead to significant changes in market structure. After surpassing this level, the price may signal the start of a new upward trend. During this process, it's crucial for investors to remain vigilant, monitor whether the breakout is supported by volume, evaluate potential pullbacks, and cross-check with other technical indicators. These types of breakouts can offer opportunities for both short-term gains and long-term positioning. With proper analysis and strategic moves, it is possible to maximize returns from these breakouts. However, we cannot rely solely on trend lines for analysis. Let's take a look at other metrics as well. Stay tuned.
The Elliott wave theory is a well-established and widely used method in technical analysis that suggests market movements progress in specific wave patterns. According to this theory, a trend advances in 5 main waves and ends with 3 corrective waves. Each wave within this 5-wave structure reflects investor psychology and market momentum. In the current scenario, the price appears to be completing its second wave and preparing for the third wave. This is a highly critical and exciting point from a technical analysis perspective, as the third wave is typically the strongest and longest. If this wave extends to the 2.272 Fibonacci extension, the price could potentially reach the $0.115 level. The second wave generally follows the initial upward movement of the first wave and represents a corrective phase. This correction is a period marked by short-term profit-taking, uncertainty, and hesitation, although the overall trend remains upward. During the second wave, investors often take profits from the initial rally, while new buyers wait for the market to dip to lower levels before entering. Therefore, the end of the second wave is often a turning point where major investors take positions, volume increases, and the upward trend reignites. This cyclical structure inherent in Elliott waves becomes particularly dynamic during the transition to the third wave. The third wave typically aligns with a period of improving fundamentals, positive news flow, and strengthening investor sentiment. As the second wave correction ends, prices begin to gain upward momentum, which often transforms into a rapid and high-volume rally. During the third wave, the majority of investors become convinced that the trend is upward and buying activity accelerates significantly. This enables prices to reach Fibonacci extension levels. Let's now focus on the potential target of the third wave at the 2.272 Fibonacci level. If this level is reached, the price is projected to rise by approximately 370%, potentially hitting around $0.115. Fibonacci extensions are especially useful in determining the targets of the third and fifth waves. The 2.272 level is typically targeted in exceptionally strong bullish runs. Reaching this level is a significant indicator not only from a technical standpoint, but also in terms of market structure and investor psychology. Investor psychology undergoes a dramatic shift during the third wave. While the second wave correction brings some hesitation following the initial rally of the first wave, this uncertainty is replaced by confidence during the third wave. A large portion of investors begin to believe that the uptrend will continue and start buying under the influence of FOMO. This leads to even higher trading volumes, increased demand, and a rapid price surge. Thus, the third wave is the most convincing and powerful phase of the cycle, both technically and psychologically. The likelihood of the price reaching $0.115 can be supported by both technical and fundamental developments. For example, roadmap updates, developer activity, exchange listings, or partnership announcements can all strengthen the third wave rally. These types of fundamental developments can make Fibonacci targets derived from technical analysis more realistic and attainable. Since the 2.272 Fibonacci level is an unusual but powerful target often reached during strong bull runs, the path to this level should be carefully monitored both technically and psychologically. On the other hand, before transitioning to the third wave, it's crucial to determine where the second wave ends and whether that level serves as a strong support. Typically, the second wave ends between the 50% and 78.6% Fibonacci retracement levels of the first wave. Strong support zones at these levels provide a solid base for the third wave to begin. If the price rebounds strongly from these support levels and starts forming an upward structure, this is a strong technical signal that the third wave may have begun. The initial part of the third wave, subwave 1, often struggles to break past the previous high. However, a minor correction that follows, subwave 2, usually precedes a powerful upward move. Once subwave 3 begins, the price breaks through previous highs and moves upward with a steep angle. During this move, technical patterns often begin to form. Patterns like bull flag, cup and handle, or ascending triangle confirm the strength of the technical structure behind the rally. One of the most notable elements in this structure is that the third wave is typically supported by high volume. High volume indicates strong and committed buying, while low volume pullbacks suggest healthy corrections and signal the continuation of the uptrend. Therefore, the volume profile throughout the third wave helps determine whether the target price of $0.115 is realistically achievable. If volume increases as the price rises, this confirms strong buying pressure and supports the technical feasibility of the target. Lastly, it is essential for investors to remain cautious and disciplined during the third wave. Although the rallies during the third wave are exciting, markets never move in a straight line. There may be small corrections, profit-taking, or short-term pullbacks due to news flow. These pullbacks should generally be seen as buying opportunities. The defining characteristic of the third wave is that corrections are limited while upward moves are strong and supported by volume. Therefore, investors must be well-versed in both technical patterns and market psychology during this phase. In conclusion, the current scenario in which the price is about to complete its second wave and transition into the third wave according to the Elliott wave theory is quite promising. If the price maintains this structure and initiates the third wave, it has the potential to reach the 2.272 Fibonacci extension and climb to the 0.115 level. This rally could present major opportunities from the perspectives of technical analysis, investor psychology, and market dynamics. The key is to follow the technical signals that support the continuation of this structure and for investors to remain disciplined during this process. We should wait for the third wave to arrive.
Dreaming of a $100,000 target can be highly motivating for investors and also marks the beginning of a realistic planning process. Reaching such targets can be achieved through accurate mathematical calculations and a well-structured investment roadmap. Let's move forward based on the available data and break it down in detail. We currently have a cryptocurrency priced at $0.014. In this example, the coin in question is Xcn. Our goal is to own enough of this coin so that if it reaches a future price of $0.115, our holdings would be worth $100,000. At this point, we need to perform a few essential calculations. By addressing these step by step, we'll clarify our investment goal and determine the capital required. First, we divide our target amount of $100,000 by the anticipated future price of the coin, which is $0.115. This will tell us how many units of the coin we need to own to reach our goal. When $100,000 is divided by $0.115, it results in approximately 869,565 units of the coin. This figure represents the quantity of the coin that would equate to $100,000 if the target price is reached. So as investors, if we hold this amount of the coin when it hits $0.115, we will have achieved our target. Now we move on to the second important calculation. We now know we need 869,565 units of the coin. Next, we calculate how much capital we need to purchase this amount at today's market price of $0.014. For this, we multiply the required number of coins by the current price. This results in approximately $12,173. In other words, if we purchase Xcn today at $0.014, and if it reaches $0.115 in the future, we will need to invest only $12,173 to reach our $100,000 goal. This presents a compelling scenario. It shows that with a much smaller capital investment, making the right investment at the right time can potentially yield significant returns. This strategy outlines one of the biggest advantages of early investors. Entering the market while the price is still low brings with it both risk and high reward potential. Particularly in the cryptocurrency market, such opportunities frequently arise. However, the key point here is not just performing mathematical calculations, but also analyzing the likelihood of this goal being achieved and planning strategically accordingly. There are several factors to consider when applying this strategy. First and foremost, whether the coin can realistically reach $0.115 in the future must be seriously researched, and whether this target is supported by technical analysis, fundamental analysis, and market trends must be examined. While math tells us what the investment will cost, it's the market conditions that will determine whether the investment will succeed. Therefore, although this calculation serves as a motivational tool, it must be backed by a thorough analysis process. At this point, the investor should examine the coin's historical price action, market volume, developer team, technological infrastructure, and compare it to similar projects. If these analyses lead to the conclusion that the $0.115 target is a realistic possibility, then a $12,173 investment becomes even more meaningful. Additionally, timing plays a major role in such investments. Entering a position while the price is still low provides a cost advantage and optimizes the risk-reward ratio. Therefore, the investor must be capable of both technical and macro-level market analysis. Of course, emotional factors should not be overlooked in these types of investments. The excitement of a large goal like $100,000 can cause an investor to ignore reality. That's why no matter how big the goal is, it's crucial to remain rational, act according to a plan, apply investment strategy with discipline, and be ready to reassess the position when necessary. For example, if the price stays around $0.014 for some time, this could present a buying opportunity. But if the price unexpectedly drops, the investors should reevaluate their position and activate stop-loss mechanisms. Also, the $12,173 amount mentioned in this example may not be accessible to every investor. In that case, the same calculation logic applies for those looking to invest smaller amounts. For instance, an investor who wants to invest $6,000, half of that amount, could earn approximately $50,000 if the target is reached. These types of investments can also be planned using a dollar-cost averaging strategy. Gradual purchases at low levels reduce average cost and allow for more controlled risk management. So regardless of the investor's budget, it's important to correctly define the target price and the necessary steps to reach it. Lastly, the concept of patience should not be forgotten in these types of investments. In crypto markets, prices can move sharply in a short time, but may take a long time for certain targets to be realized. Investors should remain patient and stick to their long-term strategy rather than reacting impulsively. Of course, patience does not mean staying in the market blindly. Market data should be analyzed regularly, and strategy should be revised when necessary. In summary, to achieve a $100,000 target, approximately 869,565 units of XCN need to be purchased at a target price of $0.115. At today's price of $0.014, this investment would cost around $12,173. For this investment to become profitable, the coin must reach the target price. Therefore, investors must not only perform calculations, but also apply effective analysis, patience, strategy, and risk management. If managed well, such investments can offer high return potential and help investors reach their financial goals.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.